everyone. I want to give you an update on the state of the market right now, what we're looking for in terms of going bearish or bullish at this point, give you an update on the overall market, also show you what industries are working really well right now and which ones we're avoiding, and also which strategies we're using right now in the market, which ones are working and which ones aren't and why. And I also want to show you some of the strongest stocks in the market and some stocks that are setting up really good patterns right now ahead of third quarter earnings season. Okay, so since we had a bullish signal here in early September, we said that this day here, a move above this prior consolidation, that was bullish for the market. And we said that generally when you get a bullish market signal this soon after a bearish signal, which we saw right here, we said it has a lower chance of leading to a sustained uptrend. And we're also in September, which generally is the worst month for the market. And so what we've seen over the past couple weeks is market pull back to test this 150-day moving average. Now, the overall trend is still looking pretty good here. We still have a very strong long-term uptrend in the market. If we go back 6 years or so on this chart here, we got a 6-year weekly chart I can show you. And we can go back further than that to, let's say, 11 years. And we can see that the long-term uptrend for the NASDAQ is still in place. Okay, so that's very good. And the question is that trend going to change here in the near term? And that's what we're most concerned about. And so far, we're not seeing strong signs of that. We're seeing pullbacks here on trade news. That's less than ideal. Okay, as far as coming up with a trade deal. That first bad news came out here in May, and we saw about a 10% correction from high to low in the NASDAQ. And then we had more bad news here in early August, and that was only a 7% pullback, I believe. And now we're leading up to another trade meeting here in early October, and we'll have to see how that works out. But this is looking like it might be even a smaller pullback than the prior one. So that kind of pattern of having smaller and smaller pullbacks, okay, and we're still hanging out here near the highs. Generally a large market correction is it generally looks a little bit different than this, and you usually don't see the market hold up or a stock hold up near the highs with more and more narrow consolidations, tighter consolidations before a big drop. Usually you see more narrow consolidations before another move higher in a stock or the overall market within a strong long-term uptrend. So that pattern is bullish. Given that we didn't move much after the bullish confirmation signal is not a good sign. Also, we have some upcoming news with earnings and with trade that could definitely be negative for the market. And early October, mid-October is often when you see a pullback, and we continue to see earnings estimates trend lower, and we could definitely see an earnings recession year over year in the third quarter and fourth quarter of this year. So there's it's a very mixed bag of signs here for the overall market. Again, to me, the longer term trend is what matters most. And, if we can still hold up above the 150-day and 200-day, if we can hold around here on a pullback, let's say, and start moving higher again, that would be fine. For the longer term, as far as I'm concerned, if we look at the Russell 2000, which is a small cap index, we can see we've been in this real narrow range here between about 1620 and 1450. We're looking at about a 10% channel right now. And we noticed, though, in the past few weeks in this latest pullback, we're actually finding support here at the 200-day moving average, it looks like. If this holds, that would be a good sign. And if we could break the short-term downtrend, that would be a good sign as well. But a lot depends on which way the market breaks as far as coming out of this consolidation. So if we break out to the upside, of course, that's better. And if we break out to the downside, that would be more bearish. And we'll just have to see how it goes. But this 200-day moving average is now starting to bend higher, turn higher, slope higher when I say that. That's what I mean when I say that, sloping higher, which is a good sign too. But overall, we're just kind of stuck in this range here. Large caps continue to outperform small caps. A big reason for that is that the small cap earnings have been declining the past few quarters, whereas large cap earnings have held up a lot better and gone a little higher. That is really affecting the small cap indices, where the small cap companies are showing weaker and weaker earnings and an earnings decline year over year. We continue to see this real, narrow consolidation, and it's pretty neutral at this point. But again, the long-term trend on the small cap Russell 2000, I think, is stronger over the long term. We can take a look here at a 11-year chart again and just see what that is. And yes, we can see it's a very, very strong long-term trend, and this may be consolidation before another move higher. So we can see here back in 2015, early 2016, where we had another earnings recession for small caps, I believe. I know that was I think a 35% pullback from high to low in the small cap index, and then that was preceding another leg higher for the small cap index. So perhaps this is another just consolidation within a longer term uptrend. Perhaps not. We'll just have to wait to see. I think a move above 1620 with some volume would be a really good sign for the small cap index and small cap companies in general. And again, we'll have to see, break out of this earnings recession and a move towards earnings growth again in the years ahead. And we'll just have to see if that happens or not. And looking at the different sectors and industries, I'm noticing that housing, consumer staples, defense, medical equipment, and a few others are leading the market. A lot of that is more defensive in nature. Consumer staples obviously is a very defensive sector. Defense, medical equipment, insurance too. Certain areas of insurance are doing well also. And of course, utilities have done really well over the past years too. So the market's been led by more defensive industries over the past year or so, and large caps more so than small caps. And so that's more of a defensive market. We'll just have to see if we get earnings growth again next year. I think a lot will depend upon what companies say in this next earnings season, if they raise estimates or lower estimates for next year, or if they stay roughly the same. That could impact the market. Of course, the trade news could impact the market, along with political news too. And with the political campaign heating up, there could be a lot of, there could be some pullbacks in the market from that as well. So we'll just see how that shapes up. And one of the industries that's not doing so well right now is biotechs. And we remember last time during an election cycle, the biotechs were hit pretty hard. This time around, they're not as overvalued in many cases as they were back then. And I think there's a lot of these stocks that are really showing good valuations at this point. If we look at one of the recent stocks that we featured on the blog about a month or two ago, we featured it down here. We said this had a good chance, if it broke this prior high here, to move up and make a nice move higher. And it did that, and it's setting up another good pattern here. This is a large cup with handle pattern, and this is within a very strong long-term uptrend as well. There are a few stocks out there in even the more beaten up industries like biotechs that are providing good technical setups and a reasonable valuation too. It looks like there's some real value in the space. However, ahead of an election, that generally don't do very well before then. So another area of the market that we're looking at, of course, is housing. And we can see here the housing index is in a really strong pattern here. It had a double bottom down here back late last year, and then it moved into a narrow consolidation after a strong uptrend, broke out, and it's forming these nice consolidations and then break into new highs. And so a lot of home builders are helping to lead the way. And one of the better ones that we're seeing right now in terms of their technical formations is MDC Holdings. And MDC Holdings had a very strong news in terms of their monthly housing numbers recently. Stock gapped up and formed this flag right here. And if it breaks out above 44.05, let's say, moves above there, that could be another good entry point on MDC. So, right now it's consolidating, moving horizontal. There's a kick off the 90 EMA here, and that might be a good entry point for it, but I would wait until it moves above this 4401 because that could be the key resistance level that it needs to break through to get to a higher level. Okay, and so you might want to wait for a close above 4401 and then move above that day's high the next day, and that might be a really good entry point on MDC if you're bullish on the stock. It seems reasonably valued at this point. The housing numbers have been coming in good overall, and that could be one opportunity to trade ahead of earnings. And you want to definitely keep track of when that earnings release is for MDC, and you can just go to Zacks or Yahoo or your favorite information provider online and see when that next earnings release is. But that's one thing I wouldn't necessarily trade ahead of earnings. Okay, so I wouldn't want to hold that through earnings. Okay, well, that about wraps it up, guys. Yeah, I think the market here could go either way. Early mid-October is usually a time for the market to pull back. I want to see this 200-day moving average, around here, at least the May lows here hold. If we do get a pullback in early October, which we often do, okay, and then the back half of the month is normally a lot better, and then we can also see if earnings are coming in pretty good. All right, but one of the things that we've noticed too recently is that the best opportunities in the market, the best swing trading setups are working as long as we get a strong catalyst around the point of entry. So right now we're holding back and just waiting for those stocks that are breaking out of good consolidation patterns, breaking short-term downtrend resistance levels within a long-term uptrend, and we want to see a new catalyst coming in at that time. Okay, so all of the stocks, or most of the stocks that are breaking swing points and hitting good bullish entry points, most of those are turning over within the first 1% to 2% or so after they do that, unless they've got that new catalyst. So right now we want to see a catalyst along with that really good swing trading entry point, like we talk about on the site. If you look under the how to play our top swing trading picks, which you'll find on the menus. And I'll show you the menus here. If you look under this menu option here, if you go under playing our swing trading picks, you'll see all those rules listed down below and different ways of playing the setups that we feature in the alert service, whether you want to go for a long-term swing trade on these top stocks, which tend to move higher over the long term more often than lower quality stocks, okay, or whether you want to go for the short-term swing trade of just, say, 5-10% or so on that swing trade. And this is actually linked to within the alert service. So in our commentary, we'll have links to this page, and that'll go over that in detail. But like we said last week, in the alert service, we're waiting for those that hit a good technical entry point, the ones that are featured in the alert service, or the explosive bottoming patterns, and also the earnings eruptions trades. If we find those, we want to definitely see a catalyst at the point of entry. Last the biggest mover was SNX, and that was an earnings eruptions trade, and that just qualified in all of our criteria and made a really nice move. It moved like 7 or 8% within an hour or two, a couple hours, I think it was, after the technical entry point was reached. And it was a very clean breakout too, which is really good sign for the earnings season coming up. And maybe we'll have a rotation in different industries and sectors, but if we can get on those and find the ones that have the really good setup that meet the requirements in the earnings eruption strategy or the high type flag strategy, let's say, meet all those criteria at the point of entry, those right now are acting really well. So we want to make sure we have all those on the radar. And if you haven't looked at it yet, there's a special right now for our top 3 strategies that we're going to be playing for earnings season. Okay, you can get all 3 of those courses, and you just click the specials button here on the home page or any page on the site. Click that specials button, and it'll come up and give you another $100 off if you buy all 3 courses. And again, those are the 3 strategies that we'll be using during earnings season ourselves in our own accounts. And right now they're looking pretty good. And we've seen a few stocks, hit those entry points and make a really nice move higher. But again, it has to meet the criteria in the course. And if it doesn't, then we avoid it. We certainly don't want to jump in on trades without that catalyst too at the good swing trading entry point. So we need a really strong combination of factors that are covered in those courses. And for the ones that appear in the alert service to large consolidation patterns on top stocks, we also want to see a strong catalyst, which at this point will probably be an earnings release that's really positive with a good outlook too. So definitely keep these on your radar. Look at them at the point of entry and make sure they have that catalyst too. And that's a really good combination that we'll be using in the weeks ahead. So, all right, that wraps it up. Good luck in your trading, guys, and we'll talk to you again real soon.